All right, let's get right into it. We're going to tackle one of the biggest debates in investing, lump sum versus dollar cost averaging. And what if I told you that the choice that feels the safest might actually be the one that's costing you a fortune?
Okay, picture this. A bonus, an inheritance, whatever. Suddenly, you've got $100,000 sitting in your bank account. First, there's that thrill, right? But then, almost immediately, it hits you. A kind of paralysis. What is the right move here? This single decision can literally change your financial trajectory. So, you're staring at this pile of cash, and you've hit what we can call the windfall dilemma. Your choice really boils down to two very different, very popular ways to get that money working. And yeah, it feels like a huge, high-stakes decision, because it is. A lot of people get completely stuck right here.
So, on one side, you've got lump sum investing, LSI for short. It's exactly what it sounds like. You take the whole $100,000 and invest it all at once. Boom, done. Full market exposure. On the other side, you've got dollar cost averaging, or DCA. This is the slow and steady approach. You break up the money and invest it in smaller chunks over, say, the next year.
Now, I'm willing to bet you've heard this a million times. From every financial guru, every website, every book, they all say the same thing, don't they? DCA is the prudent move, it's the safer path, it protects you. It's become the default advice. But is it actually good advice? That's what we're going to dig into today. And this is where things get really interesting, because this choice isn't really about finance. It's a battle between your brain and your bank account. It's what feels good versus what the cold, hard numbers say you should actually do.
Let's be real. The only reason we love DCA is psychological. We have this waking nightmare of investing a huge chunk of money on a Tuesday, and on Wednesday, the entire market tanks. Oof. DCA is basically regret insurance. It's a strategy designed to protect our ego from that awful feeling.
You can really think of it as a financial security blanket. You wrap yourself up in it and it whispers, "Don't worry, you'll never be that sucker who bought at the absolute peak." And by spreading out your buys, it's true. You'll buy some high, you'll buy some low, and it'll all average out. It's comforting, for sure. But that comfort, it's not free.
So here's the trade-off, plain and simple. The appeal of DCA, it's all emotional. You avoid that potential regret, you feel like you're in control. But the cost, well, the cost is mathematical, and it is huge. It's called opportunity cost. While you're carefully dribbling your money into the market, a massive chunk of it is just sitting on the sidelines, benched, doing absolutely nothing for you.
And let's be crystal clear about what doing nothing means for your cash. It is not sitting there safely. It is actively getting eaten alive every single day by the guaranteed force of inflation. So think about that for a second. With DCA, you are swapping the possibility of a temporary market drop for the certainty of losing purchasing power.
Okay, enough about feelings. Let's get down to brass tacks, the pure, cold data. Because there's a fundamental reason why delaying your entry into the market is, statistically speaking, a losing bet. And it all comes down to how the market behaves.
Here's the simple, boring truth that makes all the difference. Over any meaningful stretch of time, the stock market goes up, a lot more than it goes down. It has a relentless upward bias. So every single day you choose to wait, you are literally making a bet against the most powerful trend in finance.
And look at this, it's not even a close call. If you look at the S&P 500's history, the market finishes the year higher roughly 3 years out of every 4. So when you decide to DCA over a full year, you're basically making a bet that this year is going to be that one unlucky year out of 4. You're betting against the odds.
Which brings us to the big number, 70%. Study after study looking at decades of data from markets all over the world comes to the same conclusion. Lump sum investing beats dollar cost averaging about 70% of the time. This isn't an opinion, it's just the mathematical result of the fact that markets go up over time. And you know why that is? It's because your money's greatest superpower isn't your ability to pick stocks or time the market. It's time. Time is the fuel for the engine of compounding. When you choose DCA, you're intentionally telling most of your money's superpower to go sit on the bench while the game is being won. But I can hear you screaming at me right now, what about the other 30% of the time? What if I'm the unlucky one who invests right before a crash? It's a fair question. So let's tackle that fear head on. Let's talk about the absolute worst case scenario.
And look, let's give credit where it's due. This is the one scenario where DCA feels great. If you put in your $100,000 and the market tanks 30% the next day, yeah, you're going to feel sick. The DCA investor who only put in a little bit is feeling pretty smart. In the short term, DCA absolutely cushions that initial blow. No question.
But, and this is the most important part, you have to zoom out. You have to look at the long game, because even in this nightmare scenario, something amazing happens. After maybe a year or two, the lump sum portfolio, the one that got crushed, starts catching up. And within about 5 years, studies show it hasn't just caught up, it's usually surpassed the DCA portfolio. How on earth is that possible?
The reason is actually really simple. Because you invested the lump sum, you bought way more shares of the market right from the start. So even though their value dropped, you still own all those shares. When the market inevitably recovers, and it always does, you capture so much more of the upside. It's like you own the entire apartment building, while the DCA person only owns a few units. When rents go back up, the building owner makes way more money.
Okay, the math is clear, but I get it. I'm a human being. The anxiety is real. So what's the solution? It's not about being fearless. It's about being disciplined. We need a practical plan that respects the data, but also helps you sleep at night.
So here's a disciplined compromise. First, be honest about your time horizon. If you need this money in the next 5 years, it shouldn't be on the stock market at all. End of story. But if it's long-term money, here's a plan. Invest half of it immediately, today. Then invest the other half over the next 2 or 3 months, not a whole year. This gets most of your money working for you quickly while still scratching that psychological itch for a little bit of caution.
So as we wrap this up, I want to try and completely reframe how you think about risk. We are so focused on the danger of a market crash, which is temporary. But the biggest danger to your wealth isn't the crash itself. It's something far more certain and far more damaging.
And it all comes down to this. The market does not reward you for sitting on the sidelines in perceived safety. It rewards participation. The true risk isn't being in the market when it goes down. The true risk is being out of the market for all the years it goes up because you are waiting for the perfect time to get in.
And so I'll leave you with this question to really think about. We've looked at the psychology and we've looked at the math. So you have to ask yourself honestly, is the emotional comfort of waiting worth the very real price you pay in long-term growth? Is your fear of a crash silently costing you a fortune?